Hi everyone, today we're going to talk on everyone's favorite topic, which is, drum roll, taxes, okay? We're going to keep it real simple. We're going to talk about what happens when you're investing in a taxable account. That's just an account that's not protected, that's not registered, and just an account, for example. We're going to keep it real simple. We're going to talk about what happens if you invest your money in a savings account that provides you with some type of interest, right? Keep it real simple. Before I get into that, though, I want to walk you through this framework. So this framework essentially works like this. All the money you receive goes right here, and it's lifetime capital potential. This is all the money you ever receive will come through here, and then it flows through what we call the tax filter. And of course, this example is based on people who are employees. Most people are employees, so that's what happens. You get taxed as soon as you're in your pay. If, on the other hand, that money went into a registered savings account, it wouldn't even hit this pipeline. It would go straight into investment accounts. You see registered savings plan. But for today's purposes, we're talking about a taxable account, a taxable savings account, and how it works. Just keep it real simple, right? So essentially what happens is the money comes through here, the lifetime capital potential goes right here. That money hits the tax filter, and then one of two things happens. Part of those funds either goes into the future lifestyle, which is we're going to say savings or investment account, or it goes into your current lifestyle. That's just current expenses that you have, your bills, entertainment, etc., etc. Now, what we should understand is that the lower amount that goes into the current lifestyle is the more opportunity we have to put into some type of a savings or potentially investment accounts. And that goes towards our future lifestyle, our future expenses. Now, again, we're going to keep it real simple today. So we're not going to talk about investment. We're going to talk about some regular savings account. We're going to talk about what happens to a taxable savings account. Okay, so now we've gone through that. Let's get going. Right, so what happens when money goes into a taxable account? Let's see how that works. Well, again, the money comes through right here, like we said before. Then the money hits that tax filter. Immediately, you get your paycheck, you see a certain amount that gets deducted. So those contributions must flow through what we call the tax filter. And those after-tax dollars then goes into their accounts. And again, for today's example, we're going to talk about a regular savings account. It goes into that savings account, and what will happen, it will earn some type of an interest, right? And that interest will be taxable. Here in Canada, that taxable amount will be taxed as ordinary income. So that interest that's earned on the money that goes into that savings account will be taxable. And those taxes on that interest, has to be paid annually, right? So what's the ramification of that? Well, if you're paying taxes from that account, what happens is eventually it's going to reduce a bit of your account balance. Now, if you don't earn a lot of interest, then of course, you may not be paying as much, but still, it does reduce your account balance. So you pay taxes as it came in, you earn interest, and you're paying taxes and it's going out. So what happens there is that it slows the compounding rate. And compounding rates mean it's just the ability for your money to grow tax-free. So it interrupts that opportunity for constant growth, right? So while it's great that you're earning interest, what's not so great is that you're paying taxes, and so it slows your component and it slows that potential growth. And that money that could have been going towards some current lifestyle or even future lifestyle investment now has to go back out, because what happens is that it ultimately reduces your current lifestyle because you're now paying taxes yearly on the interest that's earned. So one of the things that people say is this: okay, you know what, that's all great, but at least I have the opportunity to invest in a higher account balance, invest in an account with a higher account balance. Because when you have these registered funds, these tax deferred funds, tax deferred accounts, then what happens is that there's usually some limitation on that. Would it be a tax-free savings account? Would it be an RSP? But for example, the savings account, technically, to invest as much as you want. No, there are some limitations, and the limitations may be if you get a special interest rate. So for example, if you have a 3-year or 5-year GIC, then access to that amount might be limited. So you could, within that 3-year time frame, for example, if you have a 3-year GIC, you cannot touch that account until the end of the 3 years. But generally speaking, what you should be looking at when you're investing like this, where you're paying taxes as it going in and taxes annually, is that what's the return potential? Because we already have one challenge. The challenge is that your money's not growing, it's not compounding, but you also have the potential for inflation. Not potential, you're exposed to inflation. So you got to look at your return, look at how much you're getting, how much you're actually receiving from that interest. Then you have to look at your inflation rate. So for example, if your return is say 2%, 3%, and inflation is 3%, and you really haven't earned anything, and you're also paying taxes, so you're already at a negative. Now, as we speak, we know that as we speak at this point, inflation is much higher than 2% or 3%. So what you have is the value of your money is depreciated. Not only is it depreciating, but you're also paying taxes on that, and it also interrupts compounding. The one of the things that people often don't contemplate is that the savings account is not registered, not protected. It's a non-registered account. Then it's being exposed to creditors. So these are, some of the things you should be considering if you're investing. So generally, it's just me walking through some of the simple steps and just kind of giving you a sense of how your money is taxed if it's just being placed in just a regular savings account and it's earning interest annually. This is kind of what it looks like, and these are the steps. Hopefully this is helpful. Just give you a sense. Didn't keep it too crazy, didn't get too complicated, but this is just, I consider this like taxes 101, so you get a sense of what happens when you're just investing money in a savings account that's not registered, with the potential for lower interest, lower returns compared to other feasible opportunities, exposure to inflation, then there's exposure to creditors. Now again, if you're saving money for an emergency fund, that's quite different. You want to put it in something like a savings account because you don't want it exposed to the market. But outside of that, this is kind of what it looks like. Okay, hopefully this was helpful. If you found it helpful, hit the like button and subscribe. Talk to you soon. Bye.